Transition. A few hours after the U.S. jobs report and an hour or so after the weaker ISM non-manufacturing report, Adam Skyped, "Quite a day." "Sure is." I continued, "I am not very confident in either direction, honestly. I feel like the winds of change can turn on a dime. The economy is still out of sync. Cars still have chip issues and prices are too high. Housing should have a supply issue but have an affordability issue instead. The employment picture is really a baby boomer and immigration thing. I think the service economy needs more transition to increase productivity as a way to combat slower growth from the baby boomer issue and the immigration thing. Big cap is laying off excess workers. Oil and energy is being pushed and pulled, but went through a period where producers said, screw chasing production increases when the prices are high. We don't need to do that and get caught when the prices come tumbling back down." Just a lot of stuff that is in transition. Those are just some of the immediate thoughts that came to mind. There are others as well. We just went through a surge in viewership on C-SPAN after it took until the day after January 6th to come to a consensus on the floor of the House of Representatives to choose a majority speaker. Transition is underway on that floor from Democrats to the GOP and also as witnessed from within the GOP party itself. The concessions made will be a transition in for governing for the near future, at least. Will it be better? Will it be worse? One can argue the EU is too big, too fragmented, as the needs of Italy are different than the needs of Germany. The winds of change from the transitioning from Brexit are not something that goes away either. Russia and Ukraine tilted the world on its axis in 2022, and that story is not fully written yet. I was encouraged when Byron Wien, in his list of surprises for 2023, said that a ceasefire in the second half of 2023 with negotiations to follow was one of his big surprises. The question comes, can China stay out of Taiwan, or is it going to lead to a new tilt there, a new transition? The transition from globalization is underway as the supply chain textbooks get rewritten as a result of a shift in what was once a black swan risk. A pandemic was always out there on the bell curve of risk to global supply chain, but until you experience it, you really don't know the implications. I had another bout of COVID over the holidays. It was more of a cold, yes, but the risks of a pandemic like COVID could rear its ugly head again. It ain't going away. So keep the tissues and the drugs nearby. I hope it does not transition to something more harmful. As a result, the risks to the supply chain bell curve has a pandemic risk moving from here up to here. That has companies rethinking globalization. We know chip manufacturing is being redistributed as a result of risk control. That transition won't be complete for another couple years, though. Apple may/will have to transition its production out of China. Does it just go to India, or is there another step it takes, maybe to the United States? What does that do to cost/inflation? What does that do to global relations? How does China respond? Will more companies follow suit? Global warming is a risk event that is transitioning with a new report this week that the glaciers will be all gone by the change of the century. That won't have an impact on my life, but it remains an issue for hers, our newest granddaughter, born in December. I am not trying to be a Debbie Downer or a Greggy Downer, but there is a lot of big picture items on the transition list and others we aren't even thinking about, as tends to be the case every year. Just ask Byron Wien. The good news is my specialty, technical analysis, helps to sift through all the stories and tell the stories from the perspective of the traders who push the prices higher or lower as the chapters are written. In 2022, the dollar was king until it started to lose its sheen in the last quarter of the year. On Friday, the greenback was higher going into the jobs report, but gave back a lot of those gains after lower earnings and a much weaker ISM non-manufacturing report was released. Nevertheless, the dollar is closing the first week of the new year higher despite the Friday declines. That may or may not imply a higher dollar bias or a lower dollar bias. I will explore that view and see if the technicals are transitioning as well as we head into the new week, where the CPI inflation will be the next data point that is looking to continue its transition when released on Thursday. Before I transition into the technicals for the current week coming ahead, let me talk a little bit about the CPI. The CPI is going to, in the U.S., is going to be released on Thursday at 8:30 a.m. It is another transitional, let's say, indicator. We've seen inflation come down over the last five months for the CPI. If you take a look at the 5 months, the average over the last 5 months has been 0.2%. That's the average month-on-month gain. If you take that times 12, you get 2.4% for a rough year-on-year level or annualized level for the CPI, which is close to the 2% target that the Federal Reserve is targeting. Now, on Thursday, the expectations are for a rise of 0.0%. And if you take a look at the last 6 months, then the average comes in at 0.166% for each month, or 0.16% gain for each month. And if you multiply that by 12, you get 2.0%. So it would be a nice convenient number showing the Fed that, hey, here's 6 months of the last 6 months we've seen inflation average 2% annualized, and that's working its way toward what your target is. It would be tough for the Fed to start to not think about that. They've been saying that we need inflation down for an extended period of time. Is 6 month extended period of time, or are they really going to go for the year time period? At least they're in that transitional phase, and we'll know that as long as the price can come, or the CPI can come in at 0.0, or even better than that. Minus number would be nice, but that would certainly tilt the bias in more of a risk-on sentiment if it does come in less than 0.0%. And also we should see stocks move higher, yields move lower, and the dollar move lower as well. So that's what we have to look forward to on Thursday. Of course, the opposite can happen and come in better than expectations, and all bets are off then. Then we should see the dollar move higher, interest rates move higher, and the stocks move lower as the Fed continues to keep the pedal to the metal as far as the tightening bias goes, and that should hurt the market in those respects. So that's with that said, let's take a look at some of the technicals that are driving the market. We'll start with the euro versus US dollar. And on the daily chart, what we saw in trading on Friday was the price move below the 50% midpoint of the 2022 trading range. This is the high for the year. This is the low for the year. The 50% retracement comes in at 1.0515. And on Friday, prior to the jobs report, prior to the ISM non-manufacturing, the price moved below that level and went down and tested this swing high going back to November right through here, and found support buyers against that level before rotating back to the upside. Now, this other yellow area here represents another key area that we stalled near at the high on Friday, and this area corresponds with really going back to this area through here where we had a number of different swing resistance levels through here against the area. Then we moved back above it and started to use a level as support through here, and then fell back below it, used it as resistance, and had one last test through here on a number of different times where the market held resistance and then rotated to the downside. So that level was revisited in December, and then we got a little sloppy going into the year end where the market just traded above and below it in a very narrow trading range. And in January, end December, early January, it's tried to move to the upside to yet another swing area up through here. And the same story here where we initially had support against it, and then we moved below it and used it as resistance. And then that was the last test through here before the market rotated to the downside and did the same thing through here. So both these yellow areas represent swing areas that if the market's going to go higher in the euro versus US dollar, continue the transition in that direction, it needs to get above those levels. So keep those levels in mind. First get above the 106.40 level, stay above that level, then get above the 107.46 to 108.05 level on the top side, and opens it, and that transitions more to a more bullish dynamic for that from a currency perspective. Let's take a look at the hourly chart, and we did see last week where the market did try to find resistance and keep the sellers in charge here against the 100 and 200 hour moving averages. Those are the blue and green lines through here. Finally, on Thursday, the market gave up, rotated all the way to the downside, found support buyers against this swing area down through here, and then had the data come out and force the market back to the upside here. And in doing so, the market did transition back through each of these moving averages that were resistance. And so we saw a transition from being more bearish below the moving averages to being more bullish above it. And that's how we're going to go into the new week with the euro versus US dollar trading more bullish. 106.189 is the close support, followed by this swing area in the 100-hour moving average of 105.827. As long as the price can remain above those levels, the transition remains more in favor of the buyers. With the 106.40 level, that is the level off the hourly chart, the first one to get to and through, and then we'll look toward the 61.8% retracement. Let's take a look at the dollar versus yen. We'll start by taking a look at the daily chart. And what we saw on the daily chart initially during last week's trade was a move to the downside. That move to the downside ended up taking the price below this swing area through here, where we had a low, and we lower right through here. And then we had another lows through here before we rotated to the downside in the Tuesday last week, before moving back to the upside and trading back above that level. So the sellers had their opportunities below that level, couldn't sustain them. The market moved higher, and we went up and tested another swing area. Really more in the shorter term here. This is defined by define these swing lows in December, breaking through that level, and then swing highs in December, where the market came back up to where the level broke right through here, found resistance, and moved to the downside. We moved a little bit above it in trading on Friday, but then fell back to the downside off the data and moved back to this swing area through here, where we're going to need to get below if the sellers are going to take more control. 131.24, 132.02. You can see the price is close the day near 132.06 or thereabouts, just above this area right here. That will be our target to get to and through on the downside, get through this yellow area. Watch the 132.70 level as close resistance in the new trading week that represents a 50% retracement of the 2022 trading range. From this low to this high, 50% comes in at 132.70. Let's take a look at the hourly chart, see what clues that shows us. And what we see on the hourly chart is really neutrality instead in lieu of or instead of the euro versus US dollar, where we saw the price move transition above the 100 and 200-hour moving averages for the dollar versus yen. On the way to the downside, we're ending the week between the two moving averages. So this area is going to be our barometer for the new trading week. As long as if the price remains in here, it's going to be neutral. It's not going to. It's going to make a decision whether they go to the upside or move to the downside, and that's what we're going to be looking for at the beginning of the week. For the dollar versus yen, get above 132.33 or get below 131.92, and we'll take it from there for this currency pair. That's how the transition, the bias will shift in the start of the trading week for that currency pair. Let's take a look at the sterling versus US dollar. Again, we'll look at the daily chart, and what we saw at the end of December and early January was the price waffling above and below the 200-day moving average. It was sort of a year-end type of thing. Mark wasn't sure which way he wanted to go, so it just waffled above and below that key moving average in December. We tried to stay above it after breaking above it for the first time, going back until to this time back through here, which I guess is in about September or August of last year, but it could not sustain momentum above this swing area, rotated back down to it, and then, like I said, waffled back above and below. We tried to move lower off of the at the start of the day yesterday, but then the data forced the market back to the upside, and we are trading back above the 200-day moving average at 120.22. The price is currently trading at 120.87. So stay above that level is more bullish going into the new part of the week. And the transition is certainly to the upside here for the sterling versus US dollar once again. On the hourly chart, it like the euro versus US dollar, showing the same thing, where the price tried to hold resistance against the moving averages through here on Thursday, and were successful in doing that and rotated all the way to the downside. In trading on Friday, we saw the price move back above both the 100 and 200-hour moving averages of blue and green lines. And as long as the price can remain above those levels, that would be more bullish, and the transition would be to the upside here for this currency pair. We do have a number of different swing levels through here where the market needs to get to and through that off of recent highs as the market moved up and down. This level right through here where we had a high and high is going to be one of the levels that we need to get through. And then this high through here is another level we're going to have to get to and through on the top side for the sterling versus US dollar. Let's take a look at the dollar versus Swiss next. And from this currency pair's perspective, lots of ups and downs in trading last week. The market is ending lower and below this swing area. That the yellow area is here is defined by different highs and then lows through here. We tried to find support here, broke below it there, and then reestablished support here. And as you can see, over the last few months, we've traded above and below it, including but most of December was below the level. So if the price is going to go higher, which we failed to do on Friday, we need to get above this swing area, also above this area right through here. You can see the different swing levels through here that the market's going to have to get to and through on the top side between 0.9353 and 0.9382. But as you can see, the price is below that level, so the transition remains to the downside for the dollar versus Swiss on the hourly chart. If we look at that, it gives us a little bit more of a clue as far as the short-term bias for this pair, and like the euro, like the sterling, it had a transition from, in this case, above the 100 and 200 to back below the 100 and 200 hour moving averages. Those moving averages will be our barometer for the bias in the new trading week. As long as the price can remain below them, it remains more bearish. 92.87, 93.17. Those are the levels that we're going to be watching. If the price can stay below that, but keeps the bias more to the downside here for the sterling, for the dollar versus Swiss. Let's take a look at the dollar versus Canada. On Friday, we did get a much stronger than expected Canadian jobs report. Puts a little pressure on the Bank of Japan, on the Bank of Canada. Why? Because they're going to have to continue to tighten policy, but the problem in Canada is that the interest rate hikes directly impact the mortgage rates, because most of the mortgages are variable and they get refixed as the rates go higher. And as a result, the consumer is going to be hit really hard in Canada from the low rates that we saw in beginning of 2022 to the higher rates that we saw at the end of 2022 and now into 2023. The jobs report showed much stronger growth, and that's going to keep the Bank of Canada in play as far as tightening rates. In trading on Friday, we did see the dollar move lower, the Canadian dollar move higher. And that took the price back below the 100-day moving average. What's the significance of that? Well, this transition back below that moving average line during the month right here in November. The market tested it on 1, 2, 3, 4 consecutive days, and the market could not sustain momentum below that level and moved higher. And again, earlier this week, the price came down to the 100-day moving average until we broke below that level on Friday, tilting the bias more to the downside. The last time the price closed below the 100-day moving average was back here in August. So that's significant. We had a significant close below the 100-day moving average, transitioning the bias more to the downside. As long as the price can remain below 134.67, that would keep the sellers more in control for that currency pair going into the new trading week. So be aware, be prepared. That's going to be the key level. Also watch the 38.2. I would earmark the 134.67 up to 134.99 as a ceiling here for the dollar versus Canada. As long as the price can remain below that level, the bias remains more to the downside for that currency pair. Let's take a look at the Aussie versus US dollar next. And like the dollar versus Canada, we have a key longer-term moving average in play. In this case, it is the 200-day moving average. Earlier this week, the price tried to trade above that 200-day. It actually did trade above the moving average, but didn't close above it. On Friday's trade, we did close above the 200-day moving average. And if we go back in time, you have to go back to this day right here. This goes back to June, beginning of June, June 2nd, June 3rd, where the price moved above the 200-day moving average and closed above that level on one single day. So we have another single day where the price is closed above the 200-day moving average. That was Friday. And guess what? It transitioned the bias more to the upside, but we're going to need to stay above that moving average in order to keep the buyers in control and the transition in place. That moving average currently comes in at 0.68483. So keep that, watch that level. As long as the price remains above that level, it's more bullish. On the top side, watch the 50% retracement as the next target, the confirmation target to get to and through if the buyers are to take more control, even more control. Getting above that level at 0.6915 would be what the traders would be start to look for. So watch this 200, watch 50% retracement, stay above is more bullish for the Aussie versus US dollar. Finally, let's take a look at the New Zealand versus US dollar. Again, we'll start off by looking at the daily chart. And like the Aussie versus US dollar, or unlike the Aussie versus US dollar, we broke above the 200-day moving average in early December. We came down and fell below it toward the middle to end of December here. And then in the beginning part of January, we tried to move below it until we yesterday's trade with the market failed on that break below off the data. We started to see the price move away from the 200-day moving average. So unlike the Aussie versus US dollar, which is just above the 200-day moving average, this New Zealand versus US dollar has a lot of room between it and the 200-day moving average. Nevertheless, it's going to be a level that will have to remain broken in order to keep the bias more to the upside. The other level in play is the 50%, and like the Aussie versus US dollar, or unlike the Aussie versus US dollar, this is also broken, and so we are above that level. That's a positive for here for the New Zealand versus US dollar. On the top side, we do have these target area through here where we had a number of different swing levels going back in time into 2022. It all started through here where we moved below it, and then we moved above it, and then we tried to stay below it here, and were successful on a move down here. And this here area right here kind of got a little messy. The price ended up moving above that swing area and also above the 100-day moving average. But when the market fell back below that level, what did we do? We reestablished resistance against that level. It got messy again in December where the price moved above and below the level on its way to the upside here. Here, the buyers tried to take control, but then failed and then started to use this level as resistance. So we need to get above that area between 0.6363 and 0.63948 to kickstart the bias and turn the transition even more positive or more bullish for the New Zealand versus US dollar. So lots of transitions going on in the fundamental side of the equation and also from a technical side as a result of the data that we saw on Friday from a technical perspective. So pay attention to those levels. I hope you found this video helpful to you. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.